Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Our next investor conference is less than 2 months away. The Planet MicroCap Showcase Vancouver is coming up on September 6 and 7, 2023 at the Fairmont Waterfront in Vancouver, BC. Be sure to check out an episode that I recently did with Paul Andreola, founder of Small Cap Discoveries and lead sponsor of our event, where we kind of go into why we're doing this, the whole bit. And we also just announced some of the initial companies that will be joining us in Vancouver. So be sure to go to planetmicrocapshowcase.com and see the list, the initial list right there, as well as our speakers who will be joining us, including Paul Andreola, Dave Barr from Pender Fund, Brent Todd from Canaccord Genuity, as well as Ryan Irvin from Keystone Financial. So to register and attend, please go to planetmicrocapshowcase.com. See you in Vancouver. My guest on the show today is Rick Rule, investor, speculator, and founder of Rule Investment Media. I haven't had Rick on the show since September 2021. During that time, we've seen gold tap $2,000 an ounce and remain just below, the lithium craze, and much more. I invited Rick on the show to hear what metals and mining narratives he's been paying attention to in the last 6 to 12 months and for the next 6 to 12 months. You know, Rick also does a deep dive on the 3 reasons why there's been a junior mining microcap malaise, his criteria for finding the top 5% junior mining stocks, as well as his thoughts on royalty and streaming companies. Whether you're an active investor in metals and mining, you passively follow, or even hate the industry altogether, my chat with Rick Rule has nuggets of wisdom for each and every one of you. So thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Rick Rule. Rick, great to see you, man. How you doing?
Robert, pleasure to be back with you. Thank you.
Absolutely. Look, it's been over a year or almost 2 years now since the last time we did an interview together. We put that out on September 2021. And without beating around the bush, I figured we'd just get right into it. You know, since then we've seen gold. Actually, before we get into it, I do want to give a plug. The reason I also wanted to invite you on, you have your conference coming up in Boca Raton, the Rule Investment Symposium that's happening July 23rd, 27, 2023. So I'm sure I'll put a link in there for people to go and see that. Now to get to the nitty gritty. Like I said, since September 2021, you know, we've seen gold tap 2,000 an ounce and remain just below that. We've seen a lithium craze and all sorts of other crazes out there. So, I mean, when you reflect on the last 6 to 12 months, let's say, what would you say are the main narratives that you've been paying attention to?
Well, I think probably 3 for microcap resource investors or speculators. The first would be the impact of higher interest rates and the recedence of fear in the broad economy and the impact that that's had on moderating gold prices. Gold, and to a lesser extent silver, in my experience over 50 years, have done extraordinarily well when people are concerned about the efficacy of their purchasing power in other financial instruments. The increase, as an example, in the interest paid on 12-month U.S. Treasuries has gone from 1.5% to 5%, which is to say the competing yields to gold have tripled, making these instruments relatively more attractive than they appeared in 2000. And two, despite the fact that we have raised interest rates in the U.S. economy feels at least surprisingly strong. Home sales, as an example, have declined, but housing prices haven't declined that much. Probably a gap between the bid and the ask. But whatever it's due to, the U.S. economy seems at least fairly strong, stronger than I would have expected with the increase in interest rates that we've seen. What that means is that there is more confidence, both in the U.S. economy and also in conventional savings products, which has, I think it's safe to say, weakened retail demand for gold. You will note that demand for gold among central banks and some institutional investors hasn't weakened at all. But in terms of the aspirations of microcap investors, the gold narrative that existed in 2019, 2020 has subsided. And one consequence of that is that gold-oriented equities, other than the great big ones, have subsided too. On the other side of the equation, for broad commodities markets, things like copper, iron ore, nickel to some extent, and certainly oil and gas, recession fears have really played on those markets. It is very clear to anybody who pays attention that in the major industrial commodity groups, we're facing a supply cliff, which means that supplies really begin to falter 4 or 5 years out. But despite that, you see a moderation in the futures markets for commodities, and you see very, very, very soft prices for the major commodities equities, particularly relative to their earnings and their dividend powers. I think this is explained by the fact that the market sees a recession in the offing. You can have declining supplies if you have declining demand, and prices don't move. And certainly the inverted yield curve suggests that financial markets think that we're headed for a recession as well. I don't want to weigh in on that, Robert, by the way. I have absolutely correctly called 17 of the last 3 recessions. So I don't pay too much attention to my own forecasting. As a credit analyst, I'm always afraid of credit quality, and I tend to be more of a doomster than I ought to be. But I think the third part.
I mean, Rick, we're gonna try and stay away from doom porn today. Okay, you know that's our goal. Unless you want to, we could go then.
No, I think that's a very good thing. The truth is that money is never made by pessimists. Sometimes money is kept by pessimists, but it's never made by pessimists. I think the microcap malaise in the junior resource market, particularly the mining market, is really a function of the underperformance of the companies. It's a hard thing to say. It gets me a lot of hate from the issuers, but you'll need to hear me out. I'll make you sick before I make you well later in the interview. If you merged every junior mining company in the world, let's say there's 2,500 of them or so, into one company, and you call that company Junior Explorco, in a very, very, very good year, that business would lose $2 billion. In an average year, probably $4 billion. In a bad year, probably $10 billion. And ironically, what they consider to be a good year, which is a year that they could raise a lot of money, is a bad year from an investor's viewpoint because they have more money to lose. I suspect that between 80 and 90% of the public companies in the world, the junior mining companies in the world, are lifestyle exercises or worse. They're value traps. It doesn't mean that the whole market can't do well on occasion. As Doug Casey used to say, when the wind blows, even turkeys can fly. The question for speculators is how to find a well enough fed turkey that turkey can survive until the storm comes. All that pessimism hides a wonderful fact that's been responsible for my successful speculative efforts, which is that sort of 5% of the sector, 5% of the 2,500 companies, maybe 150 companies, generate so much performance that they add legitimacy and even value to the sector. We, about 20 years ago, had a young intern, that's financial services speak for slave, who pulled 25 TSXV juniors at random, looked at the balance sheets and the income statements going back 5 years, and discovered, to his surprise and to my horror, that the average junior spent over 60% of capital raised on general and administrative expenses. Less than 40% went in the ground. And I think if you're looking at the malaise in the microcap juniors, you need to add back recession fears, increasing confidence, and increasing interest rates available to savers, and the underperformance of the sector as a whole. Against that gloomy backdrop, I'm fairly aggressively buying some of the juniors. I have done reasonably well over the last 50 years, segregating in movie sense the good from the bad from the ugly. Most speculators don't bother to do that for some reason. Their investment criteria has got a hunch, bet a bunch, which means that when the TSXV over an 18-month period is like it is, off 45%, there is no segregation in terms of what gets sold off. The good juniors, the medium juniors, and the bad juniors all fall down together, which means that the price of the good juniors has declined over the last 2 years to reflect what I think is, in many cases, great value relative to what existed 2 years ago, which was not great value. You mentioned at the beginning of the interview, too, and I'm sorry to turn this into a rant, but this is important stuff.
Great. This is why I have you on. I don't mind to let you cook. So just keep cooking. You're good.
You managed to say at the beginning of the interview that there were always crazes, and I think crazes are well known and well named. People who participate in crazes are crazy. Lithium would be a wonderful example. A lot of guys who run lithium companies today couldn't spell lithium 7 years ago. They failed looking for gold. They failed growing marijuana. They failed in launching some sort of cryptocurrency. And now they're with the latest craze, lithium. And my suspicion, given their track record, is that they will fail one more time. I note, too, that the population of lithium companies in the world has grown from probably 7 years ago to probably 200 today. What are the probabilities that there are 200 management teams in the world that are experienced in and successful around lithium? I would say that the probability of that on a percentage basis is 0. And I'm not doing this to say don't speculate on lithium. What I am saying is that you make money and resources by finding things that are out of favor, not hot. You have a commodity which has increased in 7 years by 400% in price. Markets work. The cure for high prices is everywhere and always high prices. High prices cause more supply to come online. In the case of the lithium business, we don't need more raw lithium. We need more lithium processing capacity. At the same time that they cause users of lithium to be more efficient fabricators or to find substitutes for lithium. Again, I am not saying that if somebody explores some godforsaken part of the world and discovers a very, very high grade, very, very high quality lithium mine, a mine with, say, $10 billion in situ reserves and resources that will be in the best quartile worldwide in all-in sustaining costs and the best quartile worldwide in return on capital employed, that I wouldn't be attracted to it. I don't mind being right in any commodity. It's just unusual that you are right in a commodity where you have as many competitors as you do lithium, where the price of the commodity has already gone up fourfold. Now, it's interesting for speculators that speculators who buy a narrative, the lithium narrative, of course, being distributed power, batteries, the increase in price validates the narrative. And ironically, in speculators' minds, the narrative becomes truer even as it becomes valueless. The value in the narrative after the price of the commodity has gone up by 400% is precisely a quarter as attractive as it was had you adopted the narrative early on. And so I would caution your speculators on the fourth probable reason for the malaise in microcap mining shares, which is to say, investor performance that's geared to reality. Geared to narrative, rather than geared to math. The fact that people chase commodities that are in favor and hot, that have experienced rapid share price escalations, in favor, or eschewing, I should say, in preference to commodities that are out of favor with management teams that are experienced. And I would suggest that investors' disenchantment with their own performance is the fourth reason why microcap stocks are weak. And I would say that very weakness in microcap resource stocks is precisely the reason why at this moment I'm attracted to them.
Absolutely. All right. Well, there's a lot that I want to dig in there first, but I think the first thing I want to talk about is, I think you've been on here before where we've kind of talked about how, like, a good high percentage of junior miners, it's a lifestyle type situation, and the 80 to 95% is in that place. But let's talk about that infrastructure itself, because listen, we've gone to all these events and, you know who the players are. I mean, you were working for your former employer, you guys funded and financed so many of these companies. They continue to, Sprott continue to do so today, so, I mean, it seems like it's also kind of a fundamental problem of the infrastructure itself, where it's like, all right, listen, you, as the financer, you make money on the deal, you probably structure it so there's a bit of a warrant, right? And the company doesn't care. All right, so my stock price takes a hit, whatever. That money is now going back into my paycheck. And, okay, a little bit's going to go on the ground and we're good to go, right? So, I mean, that's a clear fundamental problem in just how the infrastructure works. And, why would any investor want to invest in a game where it's like, all right, I know that I'm going to get diluted and they're going to be fine, but I'm going to be left in the dust.
I think the sooner that the investor comes to recognize that, the sooner that the circumstance changes. Make no mistake, Wall Street, Bay Street, Howe Street exist to take your money. It's your job to make sure that they give you back more than they took from you. The truth is that most investors, most people on the receiving end of outgoing phone calls from Bay Street and Howe Street, prefer hearing narrative. They prefer being excited. I was, among other things, a retail stockbroker for 40 years. And I know when I got on the phone with most investors and I started in on the math, I could feel their eyes drop. When I talked about insider selling, when I talked about general and administrative expense relative to in-ground expense, when I talked about all-in sustaining capital, when I talked about all of the factors that made a company a good speculation, most speculators' eyes glazed over. If rather than that, I talked about the potential impact of Trudeau or Obama and on gold, all of a sudden they got very excited. And it's odd that speculators get excited about the gold price when they're speculating on companies that don't have any gold. They're looking for gold. So, I really think that what you say is very true. And I think that the first line of defense is the investor, himself or herself. There is so much data out there. And investors need to avail themselves of it. And on my own channel, Rule Investment Media, you may know that I have now graded over 80,000 individual investor portfolios. They submit the portfolios. I rank the stocks in the portfolio 1 to 10. Comment on issues where I think my comments might have value, and I've learned a lot about how investors act at various points in time, and I've seen the impact of promotion and narrative on broad numbers of people. I've seen the same mistakes over and over and over again. I have asked every listener on my channel, there's 80,000 of them, to consider strongly limiting the number of stocks in their portfolio to the number of hours per month that they're willing to spend studying the stocks, reading the annual reports, reading the proxy statements, reading the insider filings, reading the quarterlies, the income statements, the balance sheets. If you're going to have 20 stocks, you need to spend 20 hours. And by 20 hours, I don't mean listening to Jim Rickard's interviews about how the world's going to hell in a handbasket, although I think you should do that too. I'm talking about spending 20 hours per month doing fundamental research on the companies in your portfolio. Robert, people will send me laundry lists of 80 stocks. Their portfolios look like mutual funds. So sometimes I call these people just for fun to educate myself. And they're usually surprised that I actually study their individual portfolios like this. But, I'll say, okay, let's start at the top, right? So I don't know what's got A in it. Amalgamated Aardvark. That'll be the first penny dreadful in the account. And I say, oh, yeah, I was really curious about that. What do you think about that, Rick? And I say, well, until this moment, I was blissfully unaware of its existence. I didn't think about it at all. Why do you own it? Oh, well, let me think. Oh, yeah, Bob Bishop recommended it. Oh, my God, Bob Bishop's been dead. He's been retired for 15 years. I mean, that's the reason you own the stock? Yeah. Well, when the reason to own the stock goes away and Bob Bishop went away, the stock has to go away too. Oh, no, Rick, I couldn't sell it. Why couldn't you sell it? Well, I paid $4 a share for it, and it's selling for 40 cents a share now. And if I sold it, I'd lose $3.60 a share. And then I have to say, no, sir, you've already lost $3.60 a share. The question is, what do you do with the last 40 cents? If you liked it at $4, you ought to love it at 40 cents. If you're not willing to sell it, you ought to buy a bunch. Do you understand how this discussion points up, I think, what's wrong with the junior mining business? People will spend hours price comparing and looking at the features around a $400 winter coat. And then they'll put $50,000 into speculative stocks on the basis of got a hunch, bet a bunch. It's insane.
But how do we change this? I mean, like between, listen, I've been interviewing you for years. I got Brent on. You do a great job. Daniela Cambone does a great job. There's some really good people that are doing good work trying to educate the masses of this you could get killed because of all these mechanics out there. What can change? It racks my brain.
I think what changes is an understanding of Pareto's law. Our job is to make this information available to people. Pareto's law teaches you that 80% of the performance will be accomplished by 20% of the people. By the way, it's a bell-shaped curve. So a different 20% of the people will experience 80% of the losses. Most of the people will be in that center, the so-called, what did Mencken say, the great unwashed. What's interesting to me is that in a large enough population base, these performance dispersal curves conformably align. I know that's wordy, but what that means is that if you take the 20% that have achieved 80% of the gains, and you run that 20% through the same performance dispersal curve, 20% of the 20% will generate 80% of the 80%, which means that 4% of the population base in any given activity, say junior mining stock exploration as an example, or junior mining stock speculation, 4% of the population will generate 65% of the gains. And I'm forced to say, although I'm in retirement now, that in terms of educating, one must reach as broad an audience as one can, and then one must concentrate their efforts on the 4 or 5% that are apt, hardworking students. I'm fully prepared to concede that out of my own database, out of an 80,000 person database, I will probably be able to materially affect the fortune of the 4,000 or 5,000 people who do the work and exert dividend. It doesn't exert effort. It doesn't mean, by the way, that I shouldn't continue to spend effort on the others. It just means in terms of the expectation that I might have of doing good, which is sort of what I want to do in my declining years, that most of the benefits of my effort will be achieved by a fairly small proportion of my audience.
At the end of the day, if we can affect one life positively with what we do, like, it makes it all worth it. But
right.
All right, so getting back to the 5%, talking more, getting our juices flowing on the 5% that of the junior miners that you'd say are actually doing some real stuff here. What would you say are some of your criteria right now for finding that 5% of the 2,500?
First of all, staying out of other people's way. You either need to go in the front end of grassroots exploration, which everybody hates right now because it's very variable. So you need to go there. The fact that everybody hates it, it's like buying straw hats in winter. It's cheap. The other part that's really cheap are the boring part of the Lassonde curve, maybe right before the project's been financed or after it's been financed in the construction phase. So I'm in front end exploration and I'm in development, because everybody else hates it. I'm also, I must admit, in the royalty and streaming business, simply because it's such a good business. For the investment part of my portfolio, the idea that I could be in a 90% margin business as opposed to an 18% margin business has some arithmetic appeal to it. So I do that. But I think the first thing that you do is stay out of other people's way to the extent that you can. If you have to screen 2,500 companies to find yourself 150 that are investable, you try to find ways to screen companies so that you won't have to waste time looking at them, so that you can lavish more love, care, and attention on the ones that you think might make you some money. People end up being hugely, hugely, hugely important. Pareto's law comes back here, too. Most people who go into the mining business as explorationists, promoters, whatever they do, never succeed at anything. Most geologists never find a mine. They're never part of a team that finds a mine. But you find other people. Ralph Roberts comes to not Ralph Roberts. It doesn't matter the name, but you find other people that have discovered 10 mines or 12 mines or 15 mines. You find people who, as property identifiers and company builders, that have been serially successful. We call them the living legends at our conference. People like Ross Beatty, people like, rest in peace, Adolph Lundin, rest in peace, Lucas Lundin, people like Bob Quartermain, incredible people. And sticking as much as you can with people who have been serially successful, or at least people who have been successful one time at a task that closely resembles the task at hand, is important. Now, Robert, if somebody comes on your show and describes themselves as having been a success in mining, but it turns out that that success was operating a gold mine in Archean terrain, 2 billion year old rock, in French-speaking Quebec, but the task at hand is exploring rather than operating for copper gold porphyries in 15 million year old accreted terrain in the Spanish-speaking Andean highlands. While they have been a success, the success is not related to the task at hand. And so it's important when you look at people that the people not only be successful, but that they be successful at the task at hand. And this just doesn't relate to the promoter. When you're looking at these companies and you're asking, hopefully the CEO, but if you have to, the IR person, take me through your management team, not just the major ego, right? Take me through the management team. Take me through the chief operating officer. Take me through the VP of exploration. Has the VP of exploration had much experience in this kind of terrain, looking for this kind of deposit, looking in these rock packages? Too often, somebody wanted to start a mining company, went to a headhunter, and they hired a geologist. And the geologist doesn't know bumpkus about the task at hand. Now, it doesn't mean that he or she can't get lucky, but counting on luck is a very, very, very bad investment technique. Similarly, what is the task at hand? If it's exploration, has the CFO been involved in exploration budgeting before? Has the CFO been involved in budgeting in the Peruvian highlands? Does the CFO understand what a reasonable quote for transporting drilling mud by helicopter in the Andean highlands look like? And by the way, does the CFO have experience raising money? The directors. Let's say there's 5 directors. Why was each director chosen? What specific area of the business does this director oversee? Or what specific task are they useful at? Is the director, as an example, good at access to British or German capital markets? That's a really good reason to have a director. Is the director a skilled explorationist? By the way, if they're exploring in Peru, do any of them spend time in Peru, or do they explore Peru from Vancouver or Toronto? Just out of curiosity, do any of them speak Spanish? It happens that having Spanish language skills is useful in Peru. So I think people are important, in addition to the sort of contrarian instinct to begin with. I think, too, the size of the prize is increasingly important to me. What you learn, particularly in exploration, is that most of your decisions are mistakes. The arithmetic around exploration when I was in university was that 1 in 3,000 mineralized anomalies became a mine. You need to do a lot to balance the odds in your favor. But one of the things that you can do is understand that if you're disciplined, your failed speculations can cost you 25%, but your successes can make you 1,000%. And that's wonderful arithmetic. 1,000% gain amortizes a lot of 25% losses and leaves room left over for an acceptable rate of return. But it only does it if you are looking for big rewards when you're taking big risks. So I would suggest to your listeners that any target that doesn't have in situ recoverable reserves or resources associated with the target of less than $2 billion isn't worth your time. A 500,000 ounce gold deposit has every risk associated with it that a 5 million ounce gold deposit has, but a 500,000 ounce gold deposit can only make you a little bit of money, and a 5 million ounce deposit can make you a lot of money. So if you're going to take big risks, you got to be in the game for big rewards. Now we get into the weeds a little tiny bit, Robert, but you got to get in the weeds. Building companies really is accomplishing small tasks on the way to a big goal. Exploration, in particular, is answering a series of unanswered questions, learning more about the deposit and its viability. It's important to ask the management team, what's the most important unanswered question that you have in front of you? How much value do you think it would add? How much does it cost for the test? And what is the time required for the test? Robert, I would suggest to you that I've been asking that question for 30 years, and 80% of the companies that I asked the question of have never considered the problem in that regard. I suspect that to them, the most important unanswered question is, will I be getting a salary in 18 months? And while I understand that's vital to them, it's of less interest to me, frankly. So this intellectual pathway to adding value, answering unanswered questions, is important. And it's important that when you ask the question, you ask the follow-on questions. How was the exploration thesis developed? Was it based on the facts at hand, or was it developed to mine Bay Street for money? Is the method proposing to test the thesis valid? Will it yield an answer that the market will care about? Importantly, how long will it take?
Rick, not to stop you, but how can you tell the difference between a thesis that's clearly like, all right, this is just to go raise capital versus, okay, this thesis may have some merit?
Ask how the thesis was developed. Who developed the thesis? Do they have any expertise? I mean, if the guy was a house painter, do you really care what his exploration thesis was? And ask him or her to explain to you the ground truths that went into the thesis. In other words, what data caused them to develop the thesis? Mostly when you ask that, they don't have one. Now,
It's like
it's
there's an elephant here, or
yeah,
there was this mine was discovered here. Like, is that an example of that? Like, well,
look,
I don't have specific data, but there's
no, that can help a lot. If
okay.
somebody says, listen, the best place to look for gold is in the head frame of a gold mine. There was a gold mine here. It was shut down. It was shut down during a period of $250 an ounce gold. That is one really good data point. So then you say, okay, I get it. The old timers probably left some gold in the ground because it wasn't economic for them to discover it at $250 gold. What data do you have? What is the surface expression? What geophysical data do you have? What supports the target? You're suggesting that there's a parallel lens, as an example. What data do you have to support that there's a parallel lens? I asked this whole series of questions very recently of Bob Quartermain, the chairman of Dakota Gold, somebody I've made money with a long time. Disclosure, I own Dakota Gold. And what he's trying to do is very interesting. They've consolidated the old Homestake mining district in South Dakota, 40 million ounce historic producer. And I said, so what you're doing is looking for additional ledges that somehow people missed over 150 years? He said, well, actually, yes, first of all, ledges away from the old one. But remember, 150 years ago, they didn't have access to, as an example, downhole geophysics. They had to go by pick over there. And we don't have to do that. We can cover, 30 square miles of claims with geophysics, but we're also looking for other styles of mineralization, hanging wall mineralization, footwall mineralization, because any event that emplaced that much gold was profound enough and multi-phase enough that there doesn't necessarily need to be one style of mineralization. And by the way, here's some hanging wall samples in a different rock package that run 6 grams gold. In addition to that, if you look to the west of us, there's wharf resources in a very, very different style of deposit, a surface deposit. So we're actually looking for 3 styles of mineralization. This is a really good answer.
Well, I was doing that. Like, are you a shareholder in Wharf? Just a guy, compliance. Bob is going out.
I'm not a shareholder of Wharf.
Okay, all right.
I am a shareholder of Dakota. But I use that not to suggest that people buy Dakota. I'm using it to say that Quartermain and his team can describe their thesis, and they can give me the reasons that they give me the way that they developed the thesis. 2, they can tell me how much of their budget is geared to testing each piece of this thesis and how long it will take. And how long it will take is important. If it's going to take 18 months to get a yes answer, and it's a yes answer, it's getting a yes answer that causes you to believe that you're going to get a reasonable return on your capital. If the time frame that you have yourself for the stock is 90 days, and it's going to take a year and a half, 18 months to test the thesis, how on earth are you ever going to be right? You need to adjust the time frame that you have in your own mind as a speculator with the time frame that is necessary to achieve the result that you're trying to achieve. And then 2, you have to have the means. Many times companies have told me when they've answered the unanswered question, series correctly, I say, well, how much money do you think you need? I say, well, let me see, 18 months, probably going to take $5 million. Okay. And how much is it going to take you to run the company for 18 months? Like the G&A? Oh, $1.5 million. So you need $6.5 million, right? Right. How much do you have? $1.8 million. Well, how's that going to work? It takes $6.5 million to get a yes answer, and you got $1.8 million in the treasury. I mean, if you tell me we're going to raise some more money, at least that's an honest answer. If you tell me you effectively have the money raised, then I want to know from who, on what terms. If as a speculator, you don't know that they have the means to answer the unanswered question, and you in your own mind, in terms of your patience, don't have the time, the probability that you're going to succeed is very, very low. And the fault is yours, not the promoters.
Absolutely. Well, I want to shift to one aspect of the industry that you brought up as one of your, I think you said favorite, but royalties and streamers, because amongst our generalist crowd, like I'd say that probably gets the most looked at, just because, when it comes to speculating, sometimes that we just went into the weeds for about 20 minutes about how difficult that can be, which that's not to say people don't like to do the work. You got to do the work even when you're talking about royalties and streamers, because, hey, they're also speculating too. But
absolutely critical, by the way, absolutely
right.
critical. Yep.
But so let's talk about that a little bit. Why, what are, not why, I think it's pretty obvious, like royalties and streamers, if they're investing correctly, you could find a mine, they're generating some cash flow and whatnot, but in your opinion, what are some of your criteria when you're looking at some of these royalties and streamers as a business, and, just your criteria for the good ones?
Let me start off by saying that generalist speculators who want a position in resources, who want the resource beta, might consider constructing a whole portfolio of royalty and streamers and never going anywhere else. In every sector of the extractive market, the royalty and streaming companies have the lowest risk beta, which is a very good thing. In a rip-roaring bull market, of course, the companies with the highest margins have the least leverage. So you will miss part of a bull market. But probably over the course of a decade, a beta constructed portfolio around royalty and streamers may at least be the best solution that a generalist speculator could have. So editorial out of the way, okay? What I look for, and let's classify mineral royalty companies in three categories. The majors. The majors would be Franco, Wheaton, probably Osisko, probably Triple Flag, probably, did I say Osisko? Yeah, Osisko, Triple Flag, those kind of companies. Then there are the sort of large intermediates, the Sandstorms, the companies like that. And then there's the small ones. The beauty about the large ones, by the way, they're not cheap. They are priced at real premiums. But I've come to understand that they deserve the premiums. Franco-Nevada, the largest of the companies, the last time I checked, had 32 employees, including the receptionist. They run that asset on a 12 basis point management fee. They have 90% operating margins, which is to say their gross is their net. It's a very good business. And they have royalties on very, very, very large properties. In my experience, large properties generate good surprises, and small projects generate bad surprises. But really, in terms of market beta, the investor and speculator has to do a lot less work with Franco and Wheaton, because the management teams have proven themselves. If you look at 30 years at their track record with deployment of capital, it's excellent. And the surprises that you're going to get from the portfolio are almost always going to be good. When you come down those companies, even to the large ones, you have to look for some durable competitive advantage enjoyed by the company. What is it that will allow them to outcompete for smaller royalties, Franco and Wheaton, which generate so much free cash, and their peers? You have to look for a geographic specialization, a commodity specialization, deep relationships with investment banks. You have to look for some durable competitive advantage, or you have to find a company with stabilized assets that's substantially cheaper than the rest of them. If you find one that's substantially cheaper, only two good things can happen. One, the share price can go up to bridge the gap, or two, they get taken over. It's a capital-intensive business. And over time, a weak competitor with a high cost of capital gets taken over by a strong competitor with a low cost of capital. When you get down to the juniors, asset quality and sustainability is the first thing you look at. Will the company exist 2 years from now? Do they have time to work the game plan? What is the company actually worth? If you look at the package of assets in a company and you try to ascertain what you could sell that package of assets to a competitor for, what the liquidation value would be, and you compare that to the share price, the juniors should be at a discount to net asset value because you're taking more risk, and you can measure these net asset values. But most importantly, with the juniors, you need to look at durable competitive advantage and specialization. As an example, disclosure, I'm long Empress Royalty, a very, very, very small royalty company, not one for the faint of heart. the young woman who runs the company had worked for years at Endeavor Financial, which is one of the most successful mine finance houses on the planet. Structured and raised, I don't know, $8-10 billion. And Endeavor has been retained on behalf of Empress to originate royalties for them, put them in the royalty package. Now, that's a durable competitive advantage. It turns out, looking back, that prior to my investment, that the company had raised just shy of $20 million, and the net present value of their royalty package was $43 million, which is to say their track record in terms of return on capital employed was pretty good. And the net present value of $43 million compared with an enterprise value then of about $30 million, 22 million market cap and 8 million in debt. So it was selling at a discount to net asset value. There was a durable competitive advantage. And there was a very, very, very strong focus on royalty generation that was in third world and emerging markets. They didn't try to compete with generalist firms in markets like Australia and the United States. They wanted to compete in Africa, they wanted to compete in Latin America, and they wanted to compete in circumstances that were either in production or being brought into production where the financing was being done by Endeavor. That's the sort of granularity that I think you have to go into if you participate in the junior sector.
Very good. All right. And you mentioned some of the majors. Are you a shareholder in any of the major?
Yeah, absolutely.
Okay.
I mean, frankly, with regards to both Franco and Wheaton, the sale decision will likely be made by my heirs. I've owned them for a very long time. I've weathered several dramatic share price declines. I don't care. I have a sense of the value of the business. With regards to those positions, I'm not a trader. If I ever got down to two natural resource stocks in my portfolio, those would be the two. For my participation in gold beta, I realize that most of your listeners neither have my means nor my patience. But I literally mean, with regards to Franco and Wheaton, that the sell decision will likely be made by my estate.
Very good. All right. Well, I know I only got you for like 10 or so more minutes. So I wanted to kind of close out with, not crystal balling this or anything like that, but in terms of narrative, I asked you about the narratives you were paying attention to the last 6 to 12 months. What are the narratives now that you're paying attention to for the next 6 to 12 months?
Two things. What is hated? Energy is hated. So oil and gas has been a great place to be for 3 years. People say, what about alternative energy? What about the fact that Biden hates it, Trudeau hates it, Greta hates it? They hate it. I love it. I think peak oil demand occurs in about 2060. I'll give you a little statistic. Last 40 years, our civilization has spent almost $5 trillion on alternative energies. By the way, I'm not opposed to alternative energies. Spent $5 trillion, and they've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. $5 trillion has reduced fossil fuels market share by 1%, partly because of growing energy markets. Oil and gas is cheap, both in terms of beta and alpha, and it ain't going away, despite the best efforts of the big thinkers. Uranium, too, has traumatized people who were attracted to the thesis in 2020, as though the ensuing 3 years have been a lifetime. The fact that money was raised and deployed by the juniors in 2019, 2020 at prices that were often 3 times the prices today means that if the company's outlook is the same, the companies are precisely 3 times more attractive than they were at the time that they raised the money. Meanwhile, the time element with regards to the uranium bull market is done. To me, the catalyst was always, when does the Japanese nuclear fleet restart? We were always going to be fine in the uranium business in the long term because it's carbon-free baseload power, and the Chinese are building plants like mad, among others. But the near-term catalyst was the pace of Japanese restarts. When will that occur? What year? 2023. It's on us. And there's transformation in the uranium business from spot market to term market. The term market is important because it gives the producers the price stability they need for the product that allows them to finance new inventory into production, which we're seeing right now. But because of the poor price performance of uranium stocks, particularly relative to anticipated, the narrative in 2019, 2020, despite the fact that the companies have made material advances in the last 3 years, they're selling at half or a third the price, which means that they are precisely 2 or 3 times more attractive than they were then, with the time element used up. So I'm certainly attracted to the uranium space. And I'm attracted to the prospect generators in terms of grassroots exploration, using their brains and other people's money to make discovery. This is something that's not for risk-averse investors or impatient investors. The search for 10 baggers, for 20 baggers, for 30 baggers necessitates more failures than successes, and many people don't have the psychological stability to endure failure. I do, for better or for worse. And I'm attracted to the developers in the boring part of the Lassonde curve. If you build large positions, particularly in periods of dramatic price declines, after, I should say, if the company completes on time, on budget for nameplate capacity, these stocks completely re-rate. And if they don't re-rate, they get taken over. And I love both of those things. The idea that I can endure 12 or 18 months worth of boredom. By the way, boredom is better than terror. With an outcome that's probable as opposed to possible is the sort of value proposition that I really, really, really like. I guess the third thing I look for now is political jurisdictions that are hated. You don't find big deposits very often in places that lots of people look. You have to go places that people don't look for. Big copper gold deposits, I think probably you look in the Tethyan metallogenic belt, which means that you look in some harsh countries: Kyrgyzstan, Uzbekistan, Kazakhstan, Pakistan, Afghanistan, Turkey. Hard places: Congo, Zambia, Cambodia. When I look at the places I've made money in the last 3 years, they're places that other people fear to tread. I'm not saying that political risk isn't real, by the way. I lost a reasonable sum of money a couple of years ago in Russia, having made a lot of money in Russia for the preceding 20 years. So the political risk game isn't without risk, but I would much rather take political risk personally than technical risk.
Very good. All right, Rick, we covered so much. You know how much I appreciate you taking the time speaking with me. So where can our audience go and find more information on Rule Investment Media? And if it's not too late to sign up for the symposium.
Love to see your audience at my symposium, either physically in Boca Raton, Florida, or virtually. You can see my conference now from the comfort of your own home. And by the way, either physically or virtually, you'll have access to all the conference tapes for 6 months. It's impossible to absorb 50 or 52 hours of programming well in 4 days. So the recordings are invaluable. Like all of my other investment products, by the way, if you pay the tuition and you come and you didn't think you'd get your money's worth, gold-plated money-back guarantee. Tell me you didn't get your money's worth and I'll give you your money back. Love to see you at the conference. Go to rulesymposium.com. Learn all about the great speakers, learn all about the great exhibitors. By the way, every public company exhibitor there is owned in a sponsor portfolio. That doesn't mean, sadly, that every stock I buy goes up, but it does mean that every exhibitor in my conference has been subjected to enough due diligence that we own them. With regards to the second part of your question, ruleinvestmentmedia.com, as an inducement to your readers, if you come there, there's a drop-down. List your resource stocks. Please no tech, please no pot stocks, please no crypto. I'll rank those stocks 1 to 10, and I'll comment on individual issues where I think my comments might have some value.
And Rick, we're not talking just like you own 100 shares in the company. Like,
I'm okay if you own 100.
I'm talking about.
I don't want somebody to drop I don't want somebody to drop a laundry list of 100 companies that they're considering.
No, I was saying for the conference, like, oh, the sponsored, like, yeah, no,
I'm sorry. We got
100 shares in this one. Don't worry.
Yeah, I don't take, for better or for worse, I don't take small positions. If I've done enough work to invest, I want to be right.
I was just kidding.
Yep. Nope.
But Rick, I appreciate you taking the time. Thank you. And look forward to our next chat.
A pleasure. And say hi to your family for me.
Will do. Podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.